what's up everybody? Kenny Simpson here with another market update. This is the April update, which remember, we're looking backwards into March. So the data might be March or a couple months prior when it comes out. For those of you guys who don't know who I am, my name is Kenny Simpson. I am a loan officer with C2 Financial on the Simpson team. My last name is Simpson, so it's my team. But I focus on 1 to 4 unit financing properties. I work with a lot of real estate investors, work with a lot of first-time buyers, VAs, FHA, all that, self-employed. So if I can be assistance to you or anybody, my contact information is here. Please feel free to reach out with any questions. It's also, if you guys would like the slide deck to send it out to clients, to friends, family, whatever, just reach out to us and we can get that to you. And let's jump in. I know I'm very excited to jump into this. As we kind of get further and further along this year, this data is becoming very, very important. So I will say this a million times, but I'll say it again. It doesn't matter what I think is going to happen. It doesn't matter what anybody thinks that happened. It doesn't matter what anybody says. We just focus on the data. That's what I love about doing this presentation. And the data and the numbers tell us what exactly is going on. So I'm excited to jump in with you guys. I know the big topics are we going to have a housing crash? Or is there going to be a correction? Should I buy? And then, oh my gosh, Kenny, interest rates are climbing. What is this going to look like? What's the prediction? So let's jump into it. And I appreciate you guys watching and, share the video and let's jump in. So impact of rising mortgage rates on the housing trend. Well, guys, the funniest thing about this slide is if we went backwards to the slide from the beginning of the year, it would have not looked like this. The max prediction of interest rates when we shot this in just January, and Monty's sitting here looking at me, nodding her head, is I think it was 4% by National Real Estate Association. Everybody else was the high threes. So as I shoot this video today, these rates are low. So the 4.67 average rate of 30-year fix it's probably next time I shoot this slide, if rates just kind of mellow out or flatten out, they'll probably be 5%. So again, this is not even keeping up with the current trends. Mortgage rates, here's another, just basically you can see we had high mortgage rates like this back in, this was in 2018. So the last time we had rates this high was 2018. I remember it well. We came off of low rates and kind of went up, and we hit 18 and it went way down because we were starting to have a slowing, not just in housing was there slowing, more days on market, more inventory. It was good, but the economy was actually having cracks and we were slowing because we did go for that long run from the Great Recession to about 2018. And then we had a refi boom, and then COVID had another refi boom. So when you're seeing this chart, that's why it looks like a double black diamond down because rates just plummeted. Mortgage rates are likely to continue to move higher throughout the balance of 2022, although the pace of rate increases is likely to moderate. Much of the increase in rates in nearly 2022 is anticipation of what will happen later this year, especially with the Federal Reserve interest rate policy. This is the Deputy Chief Economist of Freddie Mac. So these guys might know a few things about rates because that's what they do. They basically buy all the Freddie Mac mortgages or Fannie Mae. So this is the big buyer of most of the mortgages. So basically what he's saying in here is that the rates in 2022, we probably had the majority of the movement as of today. I personally think we'll still see some gradual climb. But it seems like every week we're moving up an eighth or a quarter rate. But I think the big up, hockey stick up has already happened, and it'll probably just gradually go up. Impact of rising rates on home prices. So this is an interesting chart. Like I said, it's just data. We're going back to 93, 96, 98, 2003, 2005, 2012. The average. Basically, home prices increased 8% basically with a change of interest rates. Impact of rising rates on housing. So this is home sales. So you can see the column where it says home prices. You can see where it says home sales. And also too, the months here, that's probably the months of inventory I'm guessing on here. So that's pretty cool as well. The average is 13, which we're not even in that category. We're not even in 8 months. We're way below that. Home sales, you can see the impact they've come down. So, obviously when rates go up, people kind of usually jump off the fence, go do a refi, don't do a cash out refi, or go jump in and try to get a home before their rates go up too high. That's more of a psychological thing rather than just a reality of what should I do. I think people just freak out and make a quick decision. While higher short-term rates will push up mortgage rates, I expect some of the impact to be mitigated eventually through lower inflation. Thus, I expect the 30-year fixed mortgage rate to continue to rise, although we aren't likely to see the big jumps that occurred over the past few weeks. I don't know exactly this, quote came out, whether it was, today, yesterday, whatever, but I agree I don't think we'll see the crazy rise. I still think they'll continue to go up until we hit a threshold where they don't go up. And everybody's like, when's that threshold? Well, the market will let us know. Mostly the stock market or something. When you start seeing a correction or sell-off, it will be in the stock market first. History suggests that when rates rise, there is an initial bump in home prices as many move quickly to buy homes before rates increase further. But after that period, home prices slow. Freddie Mac analysis show that a 1% increase in mortgage rates result in home price appreciation that is 4%. Basically 4% points lower. For instance, a 1% increase in mortgage rates would change home price growth from 11 to 7%. That is a probably accurate statement in a normal market. And unfortunately, we are not in a normal market. And we will further down the road here in this presentation, you'll see that that's probably not going to be the quote we're going to use for this time because we're not in a normal market. We don't have normal inventory, and that is not helping. With rising rates and expected to rise through 2023, it makes sense to obtain a purchase or refinance mortgage if you are in good standing. That is a comment or a quote. That's up to you. We keep watching for it, but there are absolutely no signs of a market slowdown anywhere in the data. If anything, we are seeing the market continue to heat up. The most important line. There are absolutely no signs of the market slowdown anywhere in the data, D-A-T-A. This isn't a guess. This isn't a theory. This isn't the local news putting some BS article out to try to spook you or scare you, or an article where you had somewhere. We are looking at data, folks, and this is what the data is saying. It's not good. It's not good for housing to come down. Buyer traffic, we look at this every month. It still seems pretty solid. If you see some of the markets that are a little bit like lighter color, that could change when we hit summer, so the next couple months, because it's freezing cold there, and I probably wouldn't want to buy a house either if it's cold. Seller traffic, yeah, it's we would want very strong, but it's pretty friggin' weak. You see how many states are very weak? That means there's not very much inventory. Last fall, we observed that home prices, although continue to rise quite sharply, had begun to decelerate. Even the modest deceleration was on pause in January. The 19.2 year-over-year change for January was the fourth largest reading in 35 years. So if you guys don't know what year-over-year means, we're not saying from 2020 to now went up 19%. What they're saying is 1 year went up 19, and it started there, and the next year went up 19. So it's like it's every year. So when you read year over year, I don't know if you guys catch that, or year over year inflation is 8%. That means it went up 8%, then it went up 8% on top of the 8%. So that's why inflation's crazy. You're like, what do you mean 8%? It's stacking on top of each other. So it's pretty significant. 3 slides every agent should have on their phone this spring. Even if you're not an agent, you're a buyer, you're a lender, you're a title, you're an escrow, home flip, or anybody, you should have these charts, because if you're talking to somebody that might want to buy a property, or you're at the dinner table, somebody's like, I think real estate's going to crash and you guys don't know anything. These, just like I said, hey, let's look at the data. And when I have a conversation with clients and I just share data, it's amazing how they go. I go, so what do you think is going to happen now? And they go, well, I think your data just kind of answered my question. So there's nothing really to discuss. So keep that in mind, guys. Homeownership hedge against inflation. Looks 70s, 80s, 90s, 2000s, 2010, 20, 21. Obviously, in the 70s, 80s, we had more inflation. So you can see where we're at there. Obviously, 2020, 2021, I think it's going to turn out to be maybe some of the worst inflation. Potential growth in household wealth over the next 5 years based solely on increasing home equity if you purchased a $360,000 home in January 2022. Wherever you purchased a $360,000 home is definitely not in San Diego, but that's pretty awesome. Whoever did that, wherever that is. Home price forecast for 2022. So still up, we will see, but I don't know. I'm probably the average 6.7. We'll see what happens. There's still a lot of stuff going on out there, but we'll wait and see. Home sales, average days on the market. It's, So what we're looking for on this chart is if these rates have, the first thing we look for housing slowing is we'd start seeing days on market. So we would want to see the lighter coloration start. That would probably be a first sign. So if we come back to this in a month or two and we start seeing things light up, that would mean the rates are having an impact on going out. So it's slowing traffic, because I don't think we're going to get the inventory. It's slow traffic, and that means we'd have more time on market. As our buddy at Logan at Housing Wire always says, first sign is we just want more time on market. So we don't have to jump through a window, put an offer in, oh my gosh, overbid, do these crazy things to get a house. It's just a little bit more like, instead of maybe 20 offers, there's like 3 to 5 offers. New homes selling fast. I mean, look at this. This is just insanity. Percentage of distressed properties. This too, if you are a real estate agent, I would add a 4th slide. I would put this on there because what you have to understand is the percentage of distressed property sales. This is huge because this was such a big impact and it was such a big part of the sales for a long time. I mean, even look at this number. Nobody really paid attention to this. I mean, I had a client that was buying a lot of short sales in San Clemente and let's see, around 17, 18, like a lot. Like he bought a lot of houses in kind of normal neighborhoods. I was like, this is still going on. It still was. So we're literally at the 1%, which is insane. And it's been like that since the beginning of the year. Sales price of existing homes. You can see the South, that's where everybody's moving. The US, the West. So average is 15. So still strong, still on the market, still on fire. Change in home prices. It's like a freaking hockey stick up. Year-over-year change in prices. Forecast it's 5%. Current is 20%. That is off the expectation there. Inventory. Okay. So the other thing too is inventory too. I would definitely keep one of these. Probably add a 5th slide if you want to. But inventory is just insane. There is no inventory, guys. So when people come, and I have this every day, what do you think? It's going to crash this? Look, yes, housing is expensive. Yes, rates are rising. But also we have to think about it is rents are going up. People aren't moving. They're not buying. But there just is zero inventory. I don't know when inventory is going to come. I guess at some point when everybody decides they can buy a house, maybe when there's more inventory where they think they can move in. So the problem is if I go sell my house now for a record price, I'm going to go buy another house for record price. I'm going to pay higher interest rates. That means a higher tax basis. And if you pay more for the house, you're probably paying higher insurance. So the overall answer is you're going to pay more money for this house on many different levels. So I don't know if it's worth it when somebody's thinking about, should I move? They already know this is happening. Yes, people are selling and they're moving to a bigger house, but they realize it's going to cost more. And they're most likely doing this because they want a bigger house, more family, work from home, better location, whatever it is. So people are doing it, but it is more expensive today. Months of inventory of homes for sale. We have 1.7 months. It's not good. Not good at all. Year-over-year inventory, I think we know that. Mortgage credit, another one. Actually, add a 6th slide. This slide actually is one of my favorite slides. The reason why is this slide is probably one of the biggest reasons we had a housing crash. If we had lending standards like we did today, we probably would have not had a housing crash. We would have probably had some type of correction, and it would have definitely changed the whole dynamic because we would have never had this crash and people always bought cheaper properties and this, we came off the bottom and up again. it would have been definitely more of like a slowdown, but this really has more impact than everybody thinks. I always go back to this slide. I basically tell people from the scale of 1,000 to 100 or 0 to 1,000 or whatever you want to do. We're at 126. Before the bubble, you're at 868. I don't know what that decline is in numbers, but I'm guessing if I did the math, it's 70, 80 something percent less. So I can tell you right now in regards to lending, it's still tough to get a mortgage. It's not that it's hard, but they're checking everything. They want to make sure, yes, there's alternatives like non-QM and stated and P&L and bank statements, but still, we're talking stated income, stated asset, no money down. You can buy investment like that. Credit scores were terrible. It's way different. What is my hot product? Interest rates. Yes, I want to talk about interest rates real quick. Interest rates can make or break that pre-approval. They can make or break you buying a house. They could also make or break psychologically you saying, you know what, I'm going to sit back, I'm going to wait. You might be an agent listening to this, you might be a buyer, you might be anybody in the industry or just learning. Kenny, interest rates are high. I was going to wait because I talked to my uncle last weekend and he says that the market's going to crash, interest rates are going to come down, that's when you want to buy. So if you showed your uncle the slide deck, I would love to see your uncle or your cousin or somebody else explain to me how and when the market will crash and what data they're looking at. That'd be great. Please share it with me. But the other thing is interest rates. Problem is, we just went through some of the lowest interest rates that were really not reality. The government, the Fed, basically, if you guys don't know, they kind of controlled multiple things, but they controlled two things. When you hear them talk about rising, when they're going to raise the rate, that's prime rate. Okay, so keep that over here. This is prime rate. HELOCs, credit cards, business lines of credit, things like that. That's when Jerome Powell comes out, which he's probably going to do this month. He did a quarter rate. He'll probably do a half a point rate, and he might do another one. So expect in the next couple months, maybe a full point. So if you have a HELOC line that's sitting at 5%, it will go to 6%. You got a business line at 9%, it will go to 10%. So that can come up or down. When we have a recession, it will come back down. So now we're talking about the long-term rates, right? Which we focus on in my business is the treasury. Yes, there's a 3, 5, 7, 10-year treasury, the 30-year treasury. I'm talking about the 10-year. That's what we kind of look at. That treasury used to be at, when the pandemic hit, like 0.3, 0.5. We are now approaching 3.0. There's been a massive increase of the treasury going up, and that means interest rates go up. So the Federal Reserve also buys mortgage-backed securities. So when interest rates are at 2.5, 2.7, 1.875, yes, I actually locked people in at 1.875 on rates. Can you believe that? I actually did lock somebody under 2% on a 15-year fix, maybe a few of them. Those interest rates were basically being bought down by the federal government. So they were manipulating them down because they were trying, when rates go really low, that stimulates the economy, okay? So that Federal Reserve was hammering the gas pedal, redlining, 6th gear. Imagine a car going down the freeway, like just going past you as fast as possible, out of control. They were buying up every mortgage. They didn't care. Now the Fed, this time last year, said, oh, inflation's, it's not going to be around. Now they're in panic. So they started raising prime. Then they started taking their foot off the gas. So instead of buying $120 billion, now they're down to $95 billion. And they're slowly going to buy $85 billion and $75 billion. And they're supposed to just basically let the air out of the balloon. As they do this, they are not the main buyer. Their mortgages at Fannie, Freddie, FHA, they have to get somebody else comes in and buys those mortgages. Well, guess what, guys? Nobody wants to buy a mortgage at 2.5%. They don't want to. They're balance sheeting all these mortgages. The market says we'll buy them at 4%. 5%. So rates have to rise because the demand, the people that buy these mortgage-backed securities, right, like Wall Street or hedge funds, I'm trying to explain this to you, they want a higher yield. Just like you. Do you want to go put your money in a bank and say, hey, Kenny, here's a 0.001% return? No, you're like, I need to go put my money to work where I get 5%, 6%, 8%. So, all that being said, guys, interest rates are going up. They're raising rates. They're trying to slow down, ease the food costs, ease the gas costs. They're just trying to slow everything down. The housing, they're just slowing it down. How do they do that? Through interest rates, which cause people to basically get less credit, Less credit means more activity, means things will slow. When rates are cheaper, people go out and get more credit because the cost of capital is cheaper. So here we are. Interest rates. Let's go back to it. If you lock in at a 30-year fix and your rate's 5%, I know you're not excited about that because you're so looking backwards at that 2.5 that wasn't reality. I don't know if we'll ever get back there, because if we're back there, that must mean something seriously is wrong with our country, right? We'd have to go through a COVID or something. But let's just assume rates go up and then we have a market slowdown, and then the feds would come back in and they would do QE, which is quantitative easing. Right now they're doing QT, which is quantitative tightening. So you hear those terms at the time. Quantitative easing means they're going to hit that gas, and that remember that mortgage-backed security, I said they were at 120 billion and now they're at 95 billion. They're going to go to 50 billion. Maybe they're going to be at 40 billion. Then they're going to go, oh, we got to start hitting the gas again. We're going to go buy 70 billion, 80 billion. That's going to bring the treasuries down, the 10-year and the rates down. My prediction is if you lock in a 5% interest rate in 12 to 24 months, you will be able to refinance that mortgage to a lower rate. What will that rate be? I don't know. Is it 4%, 3.5%? I'm not sure what's ahead. Nobody knows. I'm not sure if it's going to be carnage ahead. I'm not sure if it's going to be an easy landing. We just don't know. Another alternative is a lot of people are doing is they're doing ARM rates, adjustable rate mortgages, a 5-year, a 7-year, a 10-year. It's a fixed 5-year, 7-year term. The interest rates typically could be a 0.5 point lower, or maybe even less, maybe a full point lower, maybe 1.5 points, depending on your credit, what we're doing. That's another alternative. You're like, Kenny, but I'm scared. What if it adjusts? The reason why clients are doing this because they know I'm going to refinance in the 5 or 7-year term, because they firmly believe, not just me telling them, they might be older, they've been through this. Yeah, Kenny, I'm just going to wait for rates to come back down. If they come back down to a normal level where I can lock in a 3.5 or 4% 30-year fix, I'll just lock in then. So my hot topic is rates. That's what I got for you. I wouldn't sit here and freak out about rates. If you're going to buy a house, you're going to refinance, focus on what you can afford, what you can buy, get the property, and yes, I truly believe that we will see rates come down. And no, I don't believe, based on the data I read today, that there's any sign of a market correction, a market crash, or anything slowing down soon. When we shoot this next month, like I said, we'll be looking for some of these things to change. Will they? We will have another month of rates higher up. So let's see if the demand falls or something changes. Thanks again for watching this video. Please share it. I appreciate the time. My contact information again is here. If you need to reach me, you have questions about pre-approval, you have questions about rates, you have questions about real estate, you have questions about what this data means, and you're a realtor or anybody and you want me to go through it, let me know. If you also want me to come in your office and give this presentation to a bunch of real estate agents, or teach you a little bit more about this, how to present it to clients, let me know. I'm also doing these type of presentations on a Zoom call with clients as well that think the market's going to crash and they think they're going to wait and buy in 3 years. Again, Kenny Simpson, thanks guys for watching.